I've lived through a few inflationary periods in my life. I'm 70 years old now, and I can tell you, inflation is nothing new. It comes and goes. But every time it comes back, people panic like it's the first time it's ever happened. I remember the 70 seconds. Oh boy, the 70 seconds were something else. Inflation was running at 10, 12, sometimes 13% a year. People were scared. They were buying gold, hoarding commodities, making all kinds of crazy decisions. And I was sitting there in Seattle, just starting Microsoft, thinking about what really matters. Back then, we were bootstrapping a company in a garage, dealing with rising costs for everything from computer parts to office supplies. But it taught me early on how to navigate economic turbulence. See, inflation is tricky. It's like a silent thief that steals your purchasing power while you're not looking. You think you have $100,000 saved up, and that feels safe. But if inflation runs at 7% for 10 years, that $100,000 can only buy about half of what it could buy before. That's terrifying for most people, and I understand why. But here's what I've learned over all these decades. Inflation doesn't change the fundamentals of good investing. It just changes which investments are good and which are bad. Let me explain what I mean by that. When I think about investing during inflation, I go back to first principles. What is inflation really? It's too much money chasing too few goods. The government prints money or credit expands, and suddenly there are more dollars floating around. But there aren't more houses, more cars, more food, so prices go up. Now, if you're holding cash during inflation, you're getting killed. Every day your cash sits there, it loses value. $1 today buys less than $1 yesterday. That's the problem with keeping money under your mattress or in a savings account earning 1% when inflation's running at 7%. You're losing 6% a year in real terms. Real terms, that's what matters. Not how many dollars you have, but what those dollars can buy. So the first rule of investing during inflation is simple. Don't hold cash. Well, don't hold too much cash anyway. You need some for emergencies and opportunities, but you don't want your wealth sitting in dollars that are melting away like ice cream in the summer sun. Instead, you want to own assets, real assets, things that hold their value or go up in value as inflation rises. And the best asset you can own during inflation, maybe the best asset you can own anytime, is a wonderful business. Let me tell you why, and this is important. A great business has what I call pricing power. That means when their costs go up because of inflation, they can raise their prices without losing customers. They can pass the inflation on to someone else. Think about Microsoft. We've been through so many economic ups and downs since the 70 seconds, and our software products have that kind of power. When costs for development or servers increase, we can adjust our pricing models, and businesses keep coming back because they rely on our tools to run their operations. It's a brand, it's a habit, it's part of their life. That's the kind of business you want to own during inflation. Companies that make products people need or love so much that they'll pay more for them no matter what. Not companies that sell commodities where the customer will just switch to whoever's cheapest. See, if you own a commodity business, let's say you're making steel or lumber or something like that, inflation destroys you. Your costs go up, but you can't raise prices because your product is the same as everyone else's. Customers just buy from whoever's cheapest. So your margins get squeezed and you suffer. But if you own a business with a moat, that's what I call it, a competitive advantage, inflation doesn't hurt you nearly as much. In fact, sometimes it helps you, because if you borrowed money at a fixed rate to build your business and now inflation comes along, you're paying back that debt with cheaper dollars while your revenues are growing. I learned this lesson in the 70 seconds. A lot of investors back then thought inflation would destroy the stock market, and for a while it did hurt, The market was terrible in the 70 seconds, but the businesses that survived, the great businesses with pricing power, they came out stronger on the other side. You know, what didn't survive well, bonds, fixed income investments. If you owned a bond paying 5% in the 70 seconds and inflation was running at 10%, you were losing 5% a year in real terms. You were going backwards. That's why I've always said bonds are not a great inflation hedge. They're a promise to pay you a fixed amount of dollars in the future. But if those future dollars are worth less because of inflation, well, you're not being protected, you're being hurt. Some people say, Bill, what about gold? Everyone says gold is an inflation hedge, and I've never been a big fan of gold. I've been pretty open about that over the years. Here's my problem with gold. It just sits there. It doesn't produce anything. It doesn't pay you dividends. It doesn't grow earnings. You know, you buy an ounce of gold today, and in 20 years, you still have an ounce of gold. Sure, maybe the price went up, but maybe it didn't. Compare that to owning a farm. If you own a farm, it produces crops every year. You sell those crops, you make money, you reinvest some of that money to improve the farm, and over time, that farm produces more and more value. It's a productive asset. Or compare it to owning a great business. That business is out there working for you every day, making products, serving customers, generating cash. And if it's a really good business, it's growing, it's compounding your wealth. Gold doesn't do any of that. It just sits in a vault, and you hope someone will pay you more for it someday than you paid. Now, I'm not saying gold is worthless. I'm just saying it's not my preference. If you want to own some gold as insurance, fine, but don't make it the foundation of your investment strategy during inflation. What should be the foundation? Productive assets, businesses, real estate that generates rent, farmland, things that produce cash flow. Let me talk about real estate for a minute, because a lot of people think real estate is the perfect inflation hedge. And, well, it can be, but it depends on what kind of real estate we're talking about. If you own rental property in a good location and you can raise the rent as inflation increases, that's a decent inflation hedge. Your property value probably goes up with inflation, and your rental income goes up too. Meanwhile, if you have a mortgage, you're paying it off with cheaper dollars. That's good. But if you own real estate that doesn't generate income, like a vacant lot or a second home you don't rent out, it's not producing anything. It might go up in value with inflation, or it might not. And meanwhile, you know, you're paying property taxes and maintenance with inflating dollars. So again, it comes back to the same principle. You want assets that produce something, that generate cash flow, that can adjust to inflation by raising prices or rents. And speaking of farmland, I've invested heavily in it over the years. I'm one of the largest private farmland owners in the US, with about 1 out of every 4,000 acres. Why? Because farmland has historically been a strong hedge against inflation. Its value tends to rise alongside rising prices. It's low volatility, not tied closely to the stock market, and it produces real yields through crops or leases. It's a productive asset that keeps giving even in tough economic times. Farmland prices have often outpaced inflation over the decades, and with global population growth and increasing demand for food, it's a way to preserve wealth while contributing to something essential. I've seen how investing in agricultural land not only protects against eroding purchasing power, but also supports innovation and sustainable farming, which ties into my broader work on climate and food security. During periods of high inflation, when food prices spike, farmland becomes even more valuable because it directly benefits from those higher commodity prices. It's not just about holding land, it's about owning something that generates ongoing returns through harvests or tenant farmers. And in my experience, diversifying into different types of farmland, whether row crops like corn and soy or permanent crops like nuts and fruits, can help mitigate risks from weather or market shifts while still providing that inflation buffer. I remember in the early days of my investing, looking at how assets like this could weather economic storms, and it's paid off over time. Someone once said, the problem with inflation is it makes everything more expensive, including mistakes. And that's true. See, when there's no inflation, you can be a little sloppy with your investments. You can make a bad decision and it doesn't hurt that much because your dollars hold their value. But when inflation's running hot, bad decisions get magnified. You lose money on the investment, and the money you have left is worth less too. It's a double whammy. So during inflationary times, you have to be even more careful. You have to focus on quality. You can't just buy any business or any property. You have to buy great businesses that will thrive no matter what happens with inflation. What makes a business great during inflation? Well, I look for a few things. First, pricing power. We talked about that. Can they raise prices without losing customers? If yes, that's good. If no, move on. Second, low capital requirements. Some businesses need to constantly reinvest in equipment, buildings, inventory, and when inflation hits, the cost of replacing that stuff goes up. So even though revenues might be rising, profits get eaten up by the need to reinvest just to stay in place. The best businesses don't need much capital. They can grow without spending a lot. Think about software companies or brands or businesses with network effects. They don't need to build new factories or buy expensive equipment. They just scale. Third, I look for businesses that own their customers. And what I mean is customers come back again and again. It's not a one-time purchase. It's recurring revenue, subscription models, repeat business, because in an inflationary environment, you want customers who are going to keep buying from you year after year. Even as prices rise, you don't want customers who buy once and disappear. Those businesses struggle. And fourth, this one's important. I look for businesses with little or no debt. Debt can be dangerous during inflation, not always. Like I said, if you borrowed at a fixed rate, inflation can actually help you. But if you borrowed at a variable rate, or if you need to keep borrowing to operate, inflation can kill you because lenders start charging higher interest rates during inflation. They want to be compensated for the fact that they're being paid back in cheaper dollars. So borrowing costs go up, and if your business needs to borrow to survive, you're in trouble. The businesses that do best during inflation are the ones with strong balance sheets, lots of cash, little debt. They can weather the storm. They can even take advantage of opportunities when other companies are struggling. I've always believed that cash is most valuable when everyone else needs it and doesn't have it. And during inflationary periods, a lot of businesses get squeezed. They run out of cash. They can't get loans. And if you have cash at that moment, or better yet, if you own a business that's generating cash, you can make incredible deals. You can buy assets at discounts. You can acquire struggling competitors. You can invest in growth when others can't. That's what we did at Microsoft during tough times. And it's the same with my investments through Cascade or the Breakthrough Energy Ventures for clean energy sectors. Like that can thrive because they're aligned with global trends and have real moats against inflation. Speaking of clean energy, I've poured a lot into Breakthrough Energy Ventures because I believe innovation in this space is not just good for the planet, but also a smart hedge against economic volatility. Energy prices fluctuate wildly with inflation, but investing in breakthrough technologies like advanced nuclear, carbon capture, or green hydrogen can create businesses that reduce dependency on fossil fuels, which often spike during inflationary periods. These ventures aim to make clean energy cheaper and more reliable, and over time, they compound value in ways that outpace inflation. For instance, small modular reactors could revolutionize power generation without the massive upfront costs of traditional plants, providing stable energy that shields economies from oil shocks. It's about betting on the future where sustainability meets profitability. And in my view, that's where the real long-term wins are during uncertain times. Let me talk about something else that's important during inflation, and that's dividends. A lot of people overlook this, but dividend-paying stocks can be a decent inflation hedge. Here's why. If you own a business that pays you a dividend and that business has pricing power, it can grow its dividend over time as inflation rises. And that's a fair question. The stock market is volatile. It does go up and down. But here's what you have to understand. The stock market is not the economy, and it's definitely not your individual investments. When you buy a stock, you're not buying a ticker symbol. You're buying a piece of a business. And if that business is a good one, if it's profitable, if it has pricing power, if it's well managed, then over time it's going to do fine, even during inflation. The stock price might fluctuate. It might go down in the short term. But if the underlying business is solid, it will survive, it will adapt, it will grow, and eventually the stock price will reflect that. I've said this for decades. If you can't handle watching your stock go down by 30 or 40% without panicking, you shouldn't be in stocks, because that's going to happen not because the business is bad, but because the market is emotional. People get scared, they sell, prices drop. But if you know you own good businesses, businesses that will thrive during inflation, you can ignore the noise. You can hold through the volatility and you'll come out ahead. Let me tell you a story. In the late 70 seconds, inflation was terrible. The stock market was going nowhere. People were depressed about stocks. They were buying gold and real estate and all kinds of things. And I was focused on building Microsoft, but I also started thinking about broader investments. People thought tech was risky amid the stagnation, but I knew that innovative businesses would figure it out. They would adjust, they would raise prices, they would cut costs, they would survive and thrive, and that's exactly what happened. The 80 seconds came along and stocks took off. The companies that had struggled through the 70 seconds, the ones with real competitive advantages, they emerged stronger. And the investors who held on through the tough times, they made fortunes. That's the lesson. Inflation is temporary. It feels permanent when you're in it, but it's not. Eventually, central banks get it under control. The economy adjusts and life goes on. But great businesses, they're not temporary. They last for decades, for generations sometimes. And if you own pieces of those businesses, you'll do just fine. Now, I want to talk about something practical. What should you actually do with your money during high inflation, like right now, today? If you're worried about inflation, what's the move? Well, first, don't panic. That's always my first piece of advice. Panic leads to bad decisions. You sell at the wrong time, you buy the wrong things, you let fear drive your choices instead of logic. Second, take inventory of what you own. Look at your investments. Ask yourself, do these businesses have pricing power? Can they pass inflation on to their customers? Are they generating cash? Do they have low debt? If the answer is yes, hold on to them. Don't sell just because you're scared of inflation. Good businesses will handle inflation just fine. If the answer is no, if you own businesses that are commodity driven or heavily indebted or struggling to make a profit even without inflation, then maybe it's time to rethink those investments. Third, make sure you're diversified. I know I always say you should concentrate your investments in your best ideas, and that's true, but you also need to protect yourself from being wrong. You need to spread your risk around a bit, own stocks in different sectors, own some real estate if you can, maybe own some inflation-protected bonds. Those are bonds where the principal adjusts for inflation, so you're not getting killed by rising prices. I'm not a huge bond fan, but those can make sense during inflation. Just don't put all your eggs in one basket, especially during uncertain times. And diversification isn't just about assets. Think globally too. I've invested in emerging markets and international opportunities because inflation doesn't hit every economy the same way. For example, countries advancing in tech or agriculture might outpace US inflation, providing a natural buffer. Fourth, keep some cash on hand for opportunities. I know I said cash is bad during inflation, and it is if you hold too much of it, but having some cash gives you flexibility. It lets you take advantage of opportunities when they arise. Because here's the thing about inflationary periods. They create winners and losers. Some businesses thrive, others struggle. And when businesses struggle, they get cheap. That's when you want to have cash to deploy. You know, you don't want to be forced to sell stocks to raise cash. You want to be ready to buy when prices are attractive. And to add to that, as I've often said, save like a pessimist, but invest like an optimist. Build that emergency fund in a high yield savings account or CDs to beat inflation on your cash, while putting the rest into long-term investments that compound over time. This mindset has guided me through market downturns, reminding me to prepare for the worst, but bet on human ingenuity for the best outcomes. Fifth, this is maybe the most important one, invest in yourself. During inflation, skills become more valuable, knowledge becomes more valuable. If you can make yourself more productive, more capable, more valuable to the marketplace, you can earn more money. And earning more money is the best hedge against inflation. I've always said the best investment you can make is in yourself. Take courses, learn new skills, read books, network, build your career, because your earning power is your greatest asset. And unlike cash, your skills and knowledge can't be inflated away. They stay with you forever. They compound over time. They make you more valuable year after year. So if you're young and you're worried about inflation, don't just worry about your investments. Worry about your career. Worry about your skills. Make yourself indispensable. Make yourself someone who can command a higher salary, who can raise their rates, who has pricing power, just like a great business does. That's your inflation hedge. That's what will protect you more than gold or real estate or any investment. In fact, when people ask me for financial advice, especially if you're earning under $100,000, I say, invest in your education. It's the foundation for wealth, giving you freedom to pivot careers, start businesses, or pursue passions. And it future-proofs you against things like AI and economic shifts. Look at how AI is transforming industries. Learning about it now could position you in high-demand fields where wages grow faster than inflation. I've seen this in my own life, starting with programming skills that led to Microsoft, and now applying learning to global health and energy challenges. Education isn't just about degrees, it's about continuous upskilling, like taking online courses in data science or renewable energy, which can open doors to inflation-resistant careers. I think about the people who've been most affected by inflation over the years, and it's always the same group: people on fixed incomes, retirees living on a pension, people who saved their whole lives in a bank account. Those are the people who suffer during inflation because they can't adjust, they can't earn more, they can't raise their prices. They're just stuck watching their purchasing power decline year after year. That's why it's so important to build an investment portfolio that can handle inflation while you're still young, while you're still working, while you still have time to adjust and adapt. If you wait until retirement to think about inflation, it's too late. You've already locked in your income. You can't go back and make different choices. But if you spend your working years buying great businesses, investing in real assets, building skills that make you valuable, then when inflation comes, and it will come, it always does, you'll be protected. You'll be fine. And speaking of retirement, I've been thinking a lot about how to structure wealth for the long haul, especially with my commitment to giving away most of my fortune through the Gates Foundation. Even in philanthropy, inflation matters, rising costs can erode the impact of grants, So we focus on high return investments that grow faster than prices, ensuring funds go further in fighting poverty and disease. It's a reminder that smart investing isn't just personal, it can amplify good in the world. I'll tell you something else, something I've noticed over the years. The people who panic most about inflation are usually the people who are making bad investment decisions anyway. If you were holding too much cash before inflation hit, you were already making a mistake. Cash doesn't compound, it doesn't grow, it just sits there. Inflation just makes that mistake more obvious. If you were invested in terrible businesses with no pricing power, that was already a bad investment. Inflation just exposes it faster. But if you were doing the right things, investing in great businesses, building skills, living below your means, staying patient, then inflation doesn't change much. It might make things a little harder, sure, but the fundamentals are the same. Good investing is good investing. Whether inflation is 2% or 10%, the businesses that were great before inflation are still great during inflation. The principles that worked before still work now. That's what people don't understand. They think inflation changes everything. They think they need a completely different strategy, but they don't. They just need to stick with what works. Own great businesses, be patient, don't panic. I remember talking to a young investor once during a period of high inflation. She was scared. She said, "Bill, I don't know what to do. Should I sell everything and buy gold? Should I move to cash? What's the right move?" And I said to her, "What do you own?" She told me she owned index funds, just simple diversified index funds. And I said, "Well, what's changed about those businesses? Are they worse companies now than they were 6 months ago?" She thought about it and said, "No, I guess not." And I said, "Then why would you sell? Just because prices are going up, that's not a reason to change your strategy." See, that's the trap people fall into. They let external circumstances, inflation, recession, whatever, dictate their investment decisions. But external circumstances shouldn't matter if you own the right things. If you own great businesses, you hold them through inflation, through recession, through whatever comes. You don't sell just because times are tough. You sell when the business stops being great, and only then. And great businesses don't stop being great just because there's inflation. They might struggle for a quarter or two while they adjust, but they figure it out. That's what makes them great. I think about Microsoft. We've been through so many inflationary periods over the decades, and every time people ask me, "Bill, how are you adjusting your strategy for inflation?" And my answer is always the same: I'm not. I'm doing what I've always done. I'm looking for wonderful businesses at fair prices. I'm holding them for the long term. I'm staying patient. Inflation doesn't change that. It's just noise. It's a distraction. And if you let it distract you from the fundamentals of good investing, you're going to make mistakes. You know what the biggest mistake is during inflation? It's trying to outsmart it, trying to trade in and out of investments, trying to time when inflation will peak and when it will come down. Nobody knows that. Not me, not the Federal Reserve, not the smartest economists in the world. Inflation is unpredictable. It can spike suddenly or come down slowly or stay elevated for years. You can't predict it, so don't try. Just focus on what you can control. Owning good assets, being patient, staying disciplined, that's all you need to do. And on that note, I've often expressed concern about the global economy, especially how inflation can exacerbate issues like rising interest rates and slowdowns. But I remain optimistic because history shows that innovation drives recovery. For example, during recent economic pressures, I've seen how investments in health and technology can create resilience, turning challenges into opportunities for growth. I'll leave you with this thought. Inflation is scary. I get it. It makes everything more expensive. It erodes your savings. It creates uncertainty. But it's also been with us for thousands of years. It's not new. And in all that time, the people who have built and preserved wealth are the ones who own productive assets, the ones who own businesses, land, skills. The ones who didn't try to hide in cash or gold or commodities, but who invested in things that produce value, that's the timeless principle, and it works just as well during inflation as it does any other time. So if you're worried about inflation, take a deep breath, look at what you own, make sure it's quality, make sure you're diversified, and then be patient. Inflation will pass. It always does. But great businesses last forever. And if you own pieces of those businesses, you'll be just fine. Thank you for watching. Now go invest in yourself and your future. Start today.